You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, well, today we are taping Options Playbook Radio on the 5th of June. The markets are actually open at this point in time, and I'm going to talk a little bit about protection. I got a lot of good feedback on my Apple backspread paper trade that we did back on May 16th. That's when the podcast was published in iTunes. And one of the biggest things about doing these, front spreads is that it's an interesting alternative to just doing a covered call, trying to bring in some protection. The FANG stocks were getting beat up a little bit at that point in time, all of them across the board. And we're talking about, well, if we can kind of get a quick turn down and a quick turn up, a way that we can get more protection if we think Apple's going to bounce back, is to take our 100 shares of Apple and go in and do a front spread alongside of those 100 shares. And what a front spread does is it means you're going to buy one call option and you're going to sell two call options against it. So by itself, it is considered naked or uncovered on that second call option. Ignore the strikes at this point in time, which is basically unlimited risk to the upside on Apple. And I really would not feel comfortable doing that ever on almost any stock, but let alone Apple. So with all that being said, if you do a front spread, but you have 100 shares of stock in your account, well, guess what? You're not uncovered, because that second call that you sold is covered by the actual 100 shares of stock. So it's kind of a way to, you got this, the stock gets beaten up on the downside. A lot of people might go and try to just sell calls to bring in premium to try to help offset the loss. But then again, then you're risking the upside potential. Well, if you do the back spread, if you get that little bounce back in the underlying stock, it allows you to close out one part of that trade, just basically the long call spread, and then you're just short the other call. And overall, you can get more money back if you do actually get the bounce. Now, if it goes down, the biggest thing about the front spread overall is that you still bring in a credit. So that was one way to manage some of the risk. And so far, this whole that strategy has worked out fine, because that's exactly what happened in Apple and a lot of the other FANG stocks, is that the market ran down, and it ran down quickly. And now the market is headed back up. And Apple went down to 175, and today it's trading at 182.48. It is up $2.84 on the day. Now, once again, we're taping this on the 5th of June, and the markets are open and moving. So it's since I got such feedback on just ways to try to generate income in your account, ways to kind of protect your account, ways to, I don't want the cheese anymore, just let me out of the trap type scenarios, hedge your account, protect your stocks. People seem to be a little bit nervous going into this summer season, considering all the political news that is going on in the markets and how volatile the marketplace has truly been. So I'm going to talk again about protection, and we're going to use Apple just because we talked about it last month. Why not just stay there? And we're going to look at how could I get true protection in Apple. Covered calls just give you the small pill to land on, and it's the same thing if you're doing it as a covered call or as a front spread with calls. The bottom line is it brings some premium in and doesn't protect you all the way down. So if we got to bang back up and you say to yourself, Apple, if Apple ever gets back to 182, I'm just, I promise I won't let it get down to 175 again without getting out. If you made a statement like that, well, here's one way that we can do it, because the nervousness is still there. The political environment is still there. All right. So by getting into this trade, what I'm going to look at is just a protective put. And protective puts, in theory, are a great concept. And if you just even think about some of the FANG stocks, if you just always bought protective puts every 3 months, but the stock just keeps skyrocketing like they have over the last 3, 4, or 5 years, well, the protective puts, if they kept you in the marketplace, that was a good thing. But most stocks don't run up enough to try to offset the premiums of buying protection in any type of stock, let alone something that's as volatile as some of the tech stocks. So if I were to look at Apple, the question, first of all, I get most often on protective puts is how far out in time do I want to go? And that is a tricky question. And I'm going to always err to closer term than further out in time. So, for example, if Apple's a protected put, if you want to talk about just so we have an example on Apple, stock's at 182.48. If we said, well, I'm going to buy a put with a strike price about 5% down, that would be around 9 points. So let's say 182.50 is where the stock is at. We buy the 172.50. That's about 10 points below. That's a little bit over 5%. If the stock comes down to that level, then I want my put to kick in and I want to protect, and I want to make sure that I can at least sell it at 172.50. I don't want to lose more than 5 or 6% on my stock. Now, the biggest thing about a protected put is that gives you that. You know that you're going to get 172.50 because you have the right to exercise and sell the stock at that level. The downside of doing that, and if you go, let's say, further out in time, first of all, it's going to cost you a lot more because time is money. But if Apple continues on up and it goes all the way up to, let's say we got a 3-month put option and Apple runs up to 210 for some reason, now my put just doesn't look that good. And so I'd have to roll it. I would have to adjust it. But I just had so much time in that position that it just doesn't warrant keeping that one put anymore, right? So when I look at buying time on protection, I'm more worried about the short term in the underlying than going out further in time. So maybe 30 days, even 15 days can work in some instances if there's a known event that you're worried about. We're just worried about the market in general. So in our example today, we're going to look at trying to get through the summer, which a decent expiration is going to be August 16th. The August 16th expiration is 72 days away. So we're going to have an earnings that's going to happen in here. We have some other big events. And I'm just going to talk about a protective put, looking at it 72 days out, knowing that that's quite a ways out in time. And then I'm going to try to find a way to get that protection in a cheaper format. In other words, I want to pay less for that protection. I don't want to pay up for all that time. So let's start by looking at just buying the protection. Okay, so if I look at the August 16 puts, stock, like I said, is 182.48. We'll call it 182.50. I look at the August 16th expiration, and I see that there is not a 172.50, but there is a 170. Okay, so this is part of the options trading world. I'd like it to be about 5% below, but guess what? There's no strike there. So either I go up and I pay more to the 175, or I go down and I pay less and get less protection at the 170. And I'm going to do that in this instance. I'm going to look at the 170 strike put. The market is 485 by 495. I'm going to call it $5 in this scenario. So if I do the math on this, I would really like some protection over the summer on some of my FANG stocks. I have 100 shares of Apple. If I buy one protective put at 170, that means that I have 12.5 points before it gets to my put. That's my risk. This is my deductible, if you will, if you think of this as an insurance product. And 12.5 points by a $182.50 stock, that's about a 7% move. 12.5 points would be about 7%. It didn't quite get down to there recently, but it came close. So if I buy this protection, that first 7% is truly at risk. If the markets go down, I can sell the put and stay long the stock if they go down a little ways. But I'm really worried more about the catastrophic event that it goes down to 155, 200, or 100, just gets beaten up big to the downside. So it doesn't protect me for the first 7%. Then on top of it, if we're going to buy protection in Apple, it's going to be fairly expensive. We got to spend $5 on that. So now at this point in time, that premium we don't get back if we're correct and the market goes down. If you think of it this way, right? Buying protection, but if the market goes down, and it takes all the way to the expiration date, that time premium is going to erode. So so we're talking about 12 points, $12.50 plus the 5 points. That's 17.5 points of risk. So now if I look at this and I talk about Apple, we're talking about a 10% move total to the downside. So a lot of people say, well, you know what? I'm just going to put the stop order in and I'm going to get an alert or whatever, and I'm just going to sell it when it gets down to that. I'm not going to pay for this put or pay for this protection. And that's usually the procedure that I see a lot of people do when they think about protective puts. They just come to the conclusion that overall it's just too expensive to do. So what would I suggest doing? And this is the strategy we're going to look at today. Look at long put spreads. Because the biggest thing about a protective put is you're buying protection from 170 all the way down to zero. Do you really think that Apple is going bankrupt anytime soon? Well, that's what that protective put is protecting you against. So a lot of people don't kind of forget to do what's called a long put spread. We're going to buy that put, but we're going to say, well, I don't think Apple is going to go down below 155, 160, 165. You pick that number. You pick the number where you're the most concerned about. And I just think that this was very enlightening to see that Apple went down below 175 and that maybe that's our target range. So here's what we're going to do. Instead of paying $5 for that 170 put 72 days out, we're going to go in and buy the 180 put, which is only 2.5 points below where the current stock is. And then we're going to sell the 165. So that's a 15-point wide put spread that puts us out until August on our 100 shares of stock. Now, I don't want to get convoluted here, but don't forget, we have 100 shares of stock. We're looking to protect that 100 shares of Apple. So we buy the 185 put, and at the same time, we sell the 165 put, August 16th expiration, 72 days away. And in this instance, now we've lowered the cost to about what that 170 put was outright. The 180 put is trading at, I'm going to round off here, 835. The 165 put is trading at 365. That puts the midpoint right around $4.70. But our protection kicks in quicker because we're buying the 180 strike, which is only 2.5 points away. Now we're truly accomplishing our goal in that if Apple goes down below 180, we have a 2.5 point deductible and a 5 points worth of premium. So our total cost here, as far as our deductible and premium, and when you're thinking about insurance, those are the terms, because that's really why we're doing this, is going to be 7.5 points. 7.5 divided by 182.50 means we're now down to a 4% overall risk. Now, here's the give up. If it goes below 165 within the 72 days, I still got risk. So my risk kicks back in below 165. Okay. So you gotta make a judgment call on that if you're okay with it. But this is, to me, especially on expensive FANG stocks, because most of them are expensive, over $100. But if you just want some protection in the short term, this is an interesting way to buy the protection. And honestly, if you're doing this, you hope that your long put spread expires worthless and Apple goes up 5 points to help pay for it over that time period. The ideal scenario would be as if it went up 10, 15 points and you stayed in it because you had this protection in your account. So to recap, we talked about protected puts, determined that was just a little too expensive to do, especially if you want to buy some time. As an alternative, we could do a put spread. Doesn't protect us the whole way down, but it does give us some protection, a 15-point range, and it greatly reduces our cost and our deductible overall, especially if you're thinking about doing time. A long put spread as opposed to an outright put purchase as a protective mechanism against the stocks that you own is an interesting way to protect against a downside move in any stock you have, let alone it being a FANG stock. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.